So, as of the time of this recording, I have about 12 years of experience in banking and financial services. And at the time when I initially started my career here, it wasn't really something that I was passionate about or knew I was passionate about. I was in my early 20s, and it was just another career move, another opportunity to elevate, get to a higher income. At the time, I also didn't realize how impactful banking, finances, and money as a whole was to my life as a whole at the time. As I developed into my career, I started to really get an amazing insight on what it looks like for people who seem to have their life together, who were financially stable or financially successful, and what their banking relationships look like, versus individuals and even households that were not doing so well in life. You could tell things were rough for them, and money was definitely a problem for them. I was able to pick up so many different strategies, tips, tactics, and insights on how things should be done when it comes to managing a banking relationship and how integral it is towards your development of, becoming successful and becoming financially successful. So what I wanted to cover in this video today is some context and some history of how far banking goes back in our civilization, as human beings, how far it goes back for us, a little bit about how it got where it is today. And most importantly, if you stick around towards the end of the video, of course, I'm going to give, a strategy and some insights on how you can better manage your banking relationships and how banks view you and how you can leverage that to elevate your financial circumstances. So stick around to the end. So I did some research to try to find out a little bit more about how far banking goes back in our history. Where did it originate from? What was the original concept, and how close is it to what we're used to today? So this is what I found. The history of banking began with the first prototype banks, that is, the merchant of the world who gave grain loans to farmers and traders who created goods between cities. This was around 2000 BCE in Assyria, India, and Sumeria. Later, in ancient Greece and during the Roman Empire, lenders based in temples gave loans while accepting deposits and performing the change of money. Archaeology from this period in ancient China and India also shows evidence of money lending. Many scholars trace the history roots of the modern banking system to medieval and Renaissance Italy, particularly the affluent cities of Florence, Venice, and Genoa. The Bardi and Peruzzi family dominated the banking in the 14th century Florence, establishing branches in many other parts of Europe. The most famous Italian bank was the Medici Bank, established by Genevieve Medici in 1397. The oldest bank still in existence, Banca Monte dei Pesci di Siena, I don't speak Italian, headquartered in Siena, Italy, which has been operating continuously since 1472 until the end of 2002. The oldest bank still in operation was the Banco di Napoli, headquartered in Naples, Italy, which has been operating since 1463. So really quickly, why are banks so important to our economy, and what is the primary functions of what banks do? So their most important role is matching up creditors and borrowers, but banks also are essential to domestic and international payment systems. Why are they important to us as individuals with our personal finances? A quick answer to that: banks and financial services industry are important parts of the economy because they provide the means for people to borrow money, make investments, save for the future, handle smaller tasks such as making deposits, paying bills, and other transfer services. So this is going to be very valuable for you to have a perspective on how important banking is to your finances. It's a really underrated part of the conversation when we start talking about building wealth and developing success in our current economic times and in the system that we function in today. Banks go back, as you can see from what we just covered, close to 4,000 years or over 4,000 years. Some form of banking, some form of medium for exchange, lending. This goes back a really long time, hundreds to thousands of years. So it's a safe indicator that, especially in our lifetime, it's not going anywhere. And it's only become more integral to the economy as well as the health of individuals financially in their personal finances. So how can you start to reinterpret your perception of your banking relationships? And how can you start to use them to leverage building wealth and advancing yourself financially? So I jotted down a couple tips and a strategy that you can start to use and employ to accomplish this goal. So as I already explained, banks are the glue to our economy. They're essential for the continuous flow of money circulating throughout our economy. And this is also makes them very important to our personal finances. Being underbanked can not only be a big inconvenience, but it can be a direct link to a poor quality of life. Having a healthy banking relationship can create synergy within your finances. Not only is it the best place to put your money, at least temporarily, but they offer complementary services and features like budgeting tools, financial education resources, money transfer tools, lending products, more and more common investment tools and products. So how do you establish the relationship with these institutions? And even more importantly, how do you start to establish it with multiple institutions? So this is a very valuable strategy if you are kind of already in a moderately financially stable position and you have the capital or the income to be able to do so. What you want to do is you ideally want to start building a strong banking relationship with a smaller or more local institution, credit union or bank. They are going to value your relationship on a much larger scale with you inputting much smaller amount of resources. So basically, they're going to appreciate your banking relationship a lot more, even if you only have hundreds or thousands of dollars to store in their institution or to have flow through their institution, than the larger institutions in our economy. Let's just put it in perspective. A smaller institution that, has $100 million in assets is going to appreciate your $5,000 or $10,000 a hell of a lot more than a multi-trillion-dollar financial institution. It's just common sense. So it's going to be very valuable for you to start building your relationship with a local institution. That's not where you're going to stop with your banking relationships by any means. But that's a great starting place because you're more likely to be treated better. You're going to be recognized there, faster. You're going to have the ability to build relationships quicker because you are going to be one of fewer customers, fewer bank balances and deposits. And this is going to help this institution value you better because, again, $100 million in assets for that institution as a whole, if you are 1% of that or 0.1% of that, 0.5% of that, it's just a bigger deal to them than it will be for a large institution. So how do you leverage developing that relationship? You're going to want to not only set up your obvious checking account or savings account, you're going to want to set up basically a network for your money to be deposited into, to start storing, to start spending out of, and to start transferring out. You basically want to create this ecosystem with that institution. So what that basically means is when you get paid, this institution is going to play an integral role in you receiving your payment and in every form of distribution of that money from that point on. So we're talking about having a checking account and setting up direct deposit. If they have it available, you want to set up online bill pay. Of course, you're going to get a debit card to be able to make your everyday purchases. You're going to want to develop a savings account to store your excess capital. better have some excess capital after your bills are paid. And you're also going to want to branch out from that point on into their lending products. Ideally, you're going to start to look into setting up a credit card or multiple credit cards over time. Once you've created this ecosystem with this smaller institution, your next focus, once you obviously have the excess capital to do it, you're in financial position to do so. Now, after let's call it 6 months, a year, even 90 days, but ideally you want to give it some time to start to develop. You want to start maxing out that relationship. You're going to graduate to a larger institution and establish a relationship there. But the way you're going to establish that relationship there is going to be a little bit different, or here's at least a different take on how you can establish that relationship with that larger institution. Larger institutions have significantly better infrastructure than the smaller ones typically do. You can go into a small local credit union or bank and see a lot of, seemingly archaic styles of doing banking. You'll see a lot more paperwork and a lot more needs to be filled out by hand. When you go to these larger, mid-sized and larger institutions, a lot of them are going to have a lot more technology in place. And this is going to be really big towards them looking to expand their business and grow their customer base, because they're going to use a lot of that technology to track their clients. And this is going to be very important for you, because as they're tracking their clients, they're creating these buckets or these different segments that break down how valuable each client is to that institution. And the higher you rank in those segments, the more effort they're going to put into trying to, recruit or gather more of your banking relationships. Some of the larger institutions in the country have the capability to detect just how much of your banking relationship is even with them versus other institutions. And this is where the bait comes in for you. The leverage comes in for you to be able to bait that bigger institution into appreciating your banking relationship. Because what you're going to do is, after you've established that stronger banking relationship with that smaller credit union or local bank, you've set up strong deposits, you've began to set up a strong system for all of your disbursements, and then you've branched out into building credit with that institution. So secured loans, secured credit cards, unsecured loan, unsecured credit cards. As you're expanding your finances, now what you're gonna do is start a checking account at that larger institution. And when you start that checking account at that larger institution, so leave it at the checking account in the early days. This is what you're going to do to leverage their ability to track and their ability to collect data points on you, to be able to market to you more, or to fight for more of your banking relationship. Once you establish that checking account, what you're going to do is, maybe you'll use that checking account for certain segments or aspects of your daily spending or certain bill pays, different things that you're not going to want to move too much of the relationship from that small institution yet. You're just going to want to bring enough of your disbursements over to this other larger institution to tease them, to give them a little bit of some data points on how you're spending your money. But most importantly, the key trick is you're going to start to move money from this smaller institution over to the larger institution when you're funding the account. So ideally, you open that banking relationship with that larger institution, you're going to want to pay close attention to what the banking requirements are to avoid service fees, because a lot of them are looking to have a direct deposit. You may have to split up your direct deposit in order to use this technique. If not, you want to try to meet the balance requirement they're going to have. Usually there's multiple ways to waive the service fee. So you're going to want to either set up a partial direct deposit or just maintain a certain minimum balance in that account to avoid the service fees. Why do you want to do it this way? Because what you want to do is take that smaller local institution. Hopefully they have the infrastructure for electronic transfers to external institutions, because not all of them do. You ideally want to do this trick electronically. You could always bring cashier's checks and things of that nature, but it works best when you're electronically transferring money from another institution. What's going to happen is you're going to start to make certain payments and conduct certain transactions in that larger institution, and your funds are going to be coming from that smaller institution. What happens when you do this internally for that larger institution? They start to gather those data points and realize, hey, this person has a very, minimal banking relationship with us, but they're moving over significant amounts of money consistently, and it's being traced because it's electronically coming from this other institution, and they know it's coming from ABC small bank, so they're looking and saying, okay, well, they only have a checking account with us, but they're moving over hundreds or thousands of dollars a month from another institution to conduct their transactions with us. So they're going to start to segment out how much of your banking relationship is with them versus with this other institution, and they're going to start to fight for it. You want this competition. This is very valuable to earning the eyes and the resources of this larger institution, for them to start to appreciate you more and work harder for your relationship, meaning they're going to bring more value to the table, trying to outcompete the smaller institution. That's what you want. So what happens in this scenario? Now you start to get offered coupons and bonuses to open more accounts with them. They start to give you offers on lending products. You might start to see pre-approvals pop up. You're going to start to see these different perks and benefits. They may offer you a special on interest rates and savings, new money on savings. Now, of course, they do these things generically, regardless of, of this trick. But trust me when I tell you, from the internal side, working within these institutions, they definitely put an effort around people who they can tell they don't have a large portion of that person's banking relationship. You also want to tease them. If you have a household, if you're not an individual, but you're a household, you either have kids, you have a spouse, relatives that you live with, you want to try to do this in bulk. You want to do this in bulk, from your smaller institution to your larger institutions. You want to start relationship banking with not only your personal ecosystem, but the ecosystem of your immediate family members around you, your kids, your spouse, relatives, parents. You want to start to make these banks compete for your banking relationship. And at that point in time, again, you're going to start to get much more value out of the larger institutions than if you went there as a whole and established that relationship with them. Because again, you bring that $5,000 or $10,000 over to one of these larger institutions, and it's okay, but it's just not going to, the bankers aren't trained to, roll out the red carpet for those kind of balances or relationships. The system isn't trained for that. But if you go to your smaller local institution, $5,000 or $10,000 is a relatively big deal. That's a relationship they're going to definitely appreciate a lot better. So you're going to basically, like I said, bridge over to these larger institutions, because each of these institutions have their own perks and benefits. Your smaller institutions may offer you better rates, but your larger institutions are going to offer you better infrastructure to move your money around. So to sum this up, you want to have stable finances when it comes to income, and you want to have a stable budget in order for this to work effectively. Because the goal is for you to be able to fill up the cup of the original institution and have enough access to start to establish a relationship with the larger institution and start to tease them into providing and offering more value for more of that smaller banking relationship that you have to graduate over. So this is going to be the first video in a series of videos that we're going to cover in a playlist that I'm going to link below if you guys will be able to access via this channel, where I'm going to teach you how to master your banking relationship to elevate your wealth. This is your financial architect, helping you build out your blueprint for prosperity. And I can't wait to see y'all soon.